Welcome back, ladies and gentlemen, to one of the most perplexing stock markets I've ever experienced in my life. We recently just saw the first signs of a slowdown in major tech earnings. We had the flash crash, the black swan event of Japan overnight raising interest rates, causing this slew of sell-off in US stocks, just really showing the complexity of global economies intertwined. Warren Buffett, finally, for the first time in what seems insane to me, selling over half of his Apple position. What does all of this mean? Well, it ties into a relatively bearish scenario for the broader markets here, and we're seeing it, right? I mean, we saw some run up after the flash crash and people thought they were discounts, but the bearishness is starting to take hand here as we finally go from, green to red today. But in the broader view, I'm not that excited yet. I mean, we're only down 8% on the S&P, VOO here. We're still up 10% pretty much on the year, which is a thrilling gain for most of us, but we are still buying stocks. My fiance, we went to her accounts, we bought some more S&P today. We've been buying more Canadian stocks, and that's just what I want to talk about. My feeling on where there's still value in tech. We're going to talk about Shopify, Palantir, Google. We'll flip to the Canadian side of the border and just preview Telus's earnings and why I think these interest rate recovery plays are still interesting as I look to buy more V&Q and some of the real estate ETFs. But first and foremost, if you're on a path to financial independence to perhaps one day retire early, go down there, hit that subscribe button, and if you enjoyed these videos, because Google to me and Meta have always been like my two favorited S&P top 10 companies as of late, primarily because the valuations have always made a lot more sense. And I'm looking at Google as a potential buying opportunity here yet again. My fiance owns a very sizable amount of Meta, which is why I won't buy it. Meta is at the top. It has always been my favorite, continues to be my favorite. But with Google starting to trade down pretty dramatically here and getting closer to a 20 price to earnings multiple and paying a 0.5% dividend yield, I'm looking at this as almost a really favorable dividend play. However, that doesn't mean it doesn't come with without risk, right? Because as many of you know, Google has actually been recently charged with being a monopoly on search, and this is a detrimental case for Google. We don't know what the penalties are, which is even more daunting, and it's part of the reason the stock's tanking. But basically, they're expected to trigger a separate proceeding to determine what the penalties Google will face. Together with Google's coming appeal, the entire process may take months or even years for potential consequences to play out. Because if you didn't know, this landmark case had to do with, Google competing with Microsoft, paying Apple tens of billions of dollars over the years to basically be the dominant search browser for the platform, the number one sold phone globally. And I'm very intrigued to see how all of this pans out moving forward. Now, I like Google because, they have YouTube, they have self-driving, they have so much going on for it. And at the right price, these stocks have always been a buying opportunity, and it might start making its way back into my portfolio as, again, a bit of a dividend pair, which is intriguing to say the least. But on the Canadian side of the border, I want to talk about some of our tech stocks, right? Shopify. I mean, we're seeing Constellation Software correct today, but we're seeing Shopify shoot way up. Why is that? Well, they posted earnings, right? And Shopify to me is a stock that I have a hard time wrapping my head around as much as I do Palantir. I've always been kind of pairing these two stocks together because they both trade at very high multiples. They trade at wicked values where you have to pull forward so much growth that there's too much risk for me kind of in between. It's kind of like Tesla. Tesla, you're playing that game of, do I want to pay a stupid high valuation for something that doesn't exist today and trust that the stock can maintain value moving forward until that growth comes into play? And that's something that you have to kind of come to your own conclusion on. But Shopify is trading up today on some pretty good revenues here. I mean, they're continuing to grow. They're a growth beast. They have been 6-month ending, $3.9 billion in revenue, $2 billion in gross profit here. I mean, they're annualizing about $4 billion in gross profit, which puts them at about a 20 times, gross profit to their price, to their market cap. Price to earnings, they don't even, for these companies, price to earnings means nothing anyways. So if we look at gross profit, which is the money they have, and the rest of the expenses are relatively controllable from there. But from gross profit, you're looking at Shopify trading about 20 times, whereas Palantir from its gross profit is trading, I think, closer to 29, 30 times. So, and the growth rates are fairly similar. If we take a look at, I believe this is gross profit, right, for Shopify. They're growing at about the 30% rate, which is really nice to see. They have great gross profit growth. Whereas we do kind of a cross comparison with Palantir. Palantir Again, a company that's getting about $1 billion in gross profit, over 6 months, annualize that out, it's about $2 billion in gross profit. And if we take a look at that, they're growing about 23%. So not nearly as fast as Shopify. And this has always been my lagging concern, because Palantir, even with the great earnings that it posted, which is proving to come back to growth, because as mentioned, one of my biggest concerns with these tech companies is when you start seeing the revenue slow down, and they've been kind of hovering in this 20 percentile range. But thanks to the last earnings, I think they're growing at a 28% clip, which is wonderful. Exactly what shareholders need to see to really justify value here, right? And I was saying that I think as an AI play that Palantir could potentially save the market if its earnings came out being gangbuster, and the only thing it could save was hardly justifying the current value that it trades at. And now the market's starting to adjust to this kind of more bearish sentiment. Now, again, both these companies are fascinating to me because the market fixates so heavily on them. And I have a hard time wanting to buy on, when every YouTuber and their grandmother talks about these companies religiously. Like I said, it puts me on edge, because if the sentiment ever shifts, these stocks can go through wicked valuation corrections, which we've seen with both these companies. I mean, Shopify hasn't even come close to recovering, and it's still an expensive stock, being down 62%, but crashed by 84%. And we saw the same thing with Palantir, right? I mean, Palantir from its peak, only which is within the recent 5 years, has dropped upwards of 80% and has recovered. But again, this recovery is a very pricey place to be buying. The real value deals were when they were down here. So anyone buying them up here, in my opinion, is just taking on far too much risk. But these are just my opinions. You do not have to agree with them. But as always, I'll show you my portfolio where I sit, is that we have recovered slightly from the lows, but we're still trading down, $15,000 odd dollars. We've been seeing, not as much as the broader market has corrected, because we do own a lot of dividend payers that have been holding up nicely. With especially like VNQ, SCHD, they've all been, playing within their range and not dropping as significantly, which is good, because that's the purpose of those ETFs, is to kind of remove some of the volatility we'd get from the S&P and more tech-oriented stocks. And I still have a lot of fear with VOO, right? I'm always going to be buying it no matter what, but you have to recognize that Apple and a lot of these big companies like Microsoft are trading at quite high multiples. And I think, as mentioned, now Microsoft is trading under the S&P 500's return this year, right? It's only up 7.43%, and it is still very expensive at a 33 times multiple. So like I said, if we don't get some earnings growth in the next quarter, or something much better to justify these, we could still see a continued correction in the broader markets, which is why I shift my focus to interest rate recovery plays, right? We've talked about Telus, we've talked about VNQ within my portfolio, and I got to add more VNQ here probably this week, but I am looking at adding some basically dividend growers, or high yielding dividend stocks that I think can justify their value today and see some growth into the future with interest rate cuts. Because Telus to me is a fascinating play. It's wiped out about what are we looking at here? A good several years worth of value, probably almost a decade's worth of value, which really turns a lot of people off, and it should. This is why you should invest most of your money in broader based ETFs. But just picking up little bits of these when I think they're trading favorably can really lock in a huge amount of capital gain return over the next decade, plus really great dividend yields that I can make my full rate of return in the dividend, which I would use to start cost averaging it and considerably into ETFs and other investments. But if we take a look, I love some of the stats that Telus gives us here. I like looking at the fact that they show economic estimates, and they show this massive increase in Canada's unemployment rate, and we're kind of at that teetering edge where I feel like it's a good time to cut interest rates, and at least we're jumping ahead of the US doing this, and we're seeing the results of somewhat of a return in REITs and some of these telecom and higher infrastructure oriented companies and the utilities. So interest rate cuts are definitely sensitive to these stocks, and we're proving that if we cut rates, these stocks do have recoveries ahead of them, unless it's just a short-term play, which it could be. But I'm really confident because of basically the debt. And if you take a look at the debt here, like the interest expense for Telus is $350 million for this last quarter, total of $696 million for the 6-month ending, which means we're annualizing a stupid almost $1.5 billion in interest expense, which they claim is an addition to the increase in the effective interest rates, right? Or our weighted average interest rate on the long-term debt, excluding commercial paper, the revolving component of Telus International, basically was 4.42% as of June 30th, 2024, compared to 4.19% just 1 year earlier. And you got to remember, a year ago, the interest rates were still materially high, right? So we need to get into this kind of cutting period now. And I really think it's going to benefit these companies greatly. If we take a look at their earnings, I mean, they're in a pretty good place. Net income, they've started to recover a bit here, which is nice. So they've done a lot of layoffs. They've done everything they had to do to cut expenditures to kind of, bring themselves down to this new baseline where I'm hoping we're going to start seeing a continued recovery in their net income. But keep in mind, there's big depreciation costs. That's something that you always have to take into consideration with these companies, because depreciation and amortization is pretty crazy. The last quarter was almost $1 billion. So when you look at a dividend that's 38 cents and you're saying, oh, they can't afford this dividend because their adjusted EPS was only 25 cents or diluted at 15, that they can't even afford the dividend. Keep in mind, they got an extra $1 billion that doesn't hit the bottom line of this EPS, but is still free cash flow they can use. So a lot of that, is what they're using to justify some of the dividend payments. So do keep that in mind. The dividend is definitely affordable here, in my humble opinion. So Telus, to me, they're on the brinking edge right now of seeing some flatlining revenue. They need to see a recovery in net income and their earnings, because this is what the stock's been following. If you just take a look at EBITDA, or even let's just look at EPS, right? Like, this is what the stock's been following, and we need to get out of this gutter. And I think we're on the bleeding edge of a recovery now. And again, these are just my humble opinions, but when I look at their mobile networks, when you look at the the fixed data services, everything is materially growing for the most part. And I love that you have health services and agricultural services and a diversified business that is seeing some growth on the lower half, which is more diverse than companies like Bell, in my opinion, that are really stuck to their legacy media and are really relying on the future of Crave. And I don't like streaming as it is outside of Google. So the two stocks that interest me the most right now have got to be Google. It's got to be some of these Canadian stocks like Telus and some of the recovery plays. So I'm going to be keeping an eye out here, and I'm always going to be investing. This isn't really spooking me that much, but I'd love to know what you think on your path to financial independence to perhaps one day retire early in that comment section below.